which is going to be a fireside chat topic, commercial payments progressing towards a digital future. This fireside chat will be moderated by Ms. Sophia Furber, Research Analyst, 451 Research, a part of S&P Global Market Intelligence, and the speaker is going to be Mr. Chris Winter, Managing Director and Head of APAC, Discover Financial Services. Let's warmly welcome them with a mighty round of applause.
Hi, good morning, namaskar. It's truly a joy to be back in Mumbai and an honor to be presenting at Global Fintech Fest. I'm Sophia Furber. I am a research analyst at 451. We're a part of S&P Global Market Intelligence. And I'm joined by Chris Winter, who is Managing Director and Head of APAC at Discover Financial Services. Good morning.
Good morning.
So we are here to discuss some of the findings of our FinTech State of the Union study, which is a huge piece of research that we have done in partnership with Discover Financial Services. It's in its fourth year now, and I believe it's the biggest research study of its kind in the industry. So I'm just going to give you a little bit of context about the survey. It's a holistic survey of payments across the world. We have sent it out to over 5,000 consumers, 2,000 plus SMEs, more than 2,000 corporates, and a handful of venture capital firms. The scope of the study covers markets including Brazil, Canada, Hong Kong, China, India, UK, US, and Canada. And what we've looked at is the payment preferences of consumers and merchants, corporates, and we've looked at some of the pain points in the fintech industry that are still remaining to be solved. So it's a very holistic study. And rather than subjecting you all to a lengthy PowerPoint presentation, we've brought Chris here today to talk through some of the key findings of the study. Now, we are going to be focusing today actually on commercial payments. As you all know, retail payments have received a huge amount of attention in the media in recent years due to the explosion in the growth of emerging payment methods such as QR codes and digital wallets. Obviously, here in India, you've got UPI, which is probably one of the most talked about innovations in global payments in recent years. But obviously, there is a lot going on in commercial payments at the moment, which is changing the way that billions of dollars of value are being exchanged between corporates. So we're going to focus on that today. So yeah, we found that actually the majority of businesses in APAC, I think 61%, are looking to invest, or they are open to investing in commercial payment solutions in the coming year. So I'd just like to have a chat to throw this over to Chris. You know, how is the way that corporates and SMEs in the APAC region, how's the way that they are approaching commercial payments changing, especially in the years since the pandemic when we've seen a seismic change in the industry? What are the key changes that you've noticed?
Well, thanks, Sophia. Firstly, good morning, everybody. It's an absolute pleasure to be here and to be first up in terms of presenting and meeting you all on this stage today at the 2024 GFF. So absolute privilege to be here. So thank you, and thank you everybody for joining us this morning. So the way I would look at commercial payments, Sophia, I think you mentioned the pandemic, and we'll mention that once or twice and probably no more, but kind of pre-pandemic and post-pandemic. I think there are a lot of similarities now that we're seeing. I think pre-pandemic was very much about travel. Commercial cards tended to fall into a couple of different categories. So there would be the traditional commercial card, which would be issued to somebody, a business traveler, that they would use and travel around, pay for airlines, hotels, restaurants, meals, those sorts of things. There would then be perhaps purchasing cards, which were very much kind of back office type things, There may be a physical card sitting somewhere in somebody's drawer, an office manager somewhere that they would use for stationery, and maybe a few other consumables that are used within an office environment or a business environment. And then we started to see, I think, the start of SMEs adopting cards. But very, very early days. And if we think about some of the challenges that we faced back then, a lot of those challenges we still see today. And we'll talk a little bit about those challenges in a few moments. I guess what I'm seeing, or what we're seeing as an industry since the pandemic, and thankfully the full recovery now of travel, international travel, both on a consumer and on a commercial basis, is an acceleration in the adoption of electronic payments and electronic forms of payments for not only those types of transactions and those products, but also increasingly into the use of statutory payments. And I think India is a phenomenal example of where that is happening. I think the adoption, the volumes that we're starting to see there in terms of those statutory payments, whether that's sales tax, government taxes, income taxes, all those different forms of taxation and forms of utility bills and things like that that businesses have to pay. We're starting to see a lot of adoption in terms of electronic payments and card payments in particular for those. And that's driving all sorts of new challenges as well. And I think the age-old challenge of data in terms of travel payments and travel cards, aligning the data, getting the claims processed, getting checks done, claiming back sales tax, aligning all of the different data inputs in terms of travel, flights, details, and things like that. Those are largely still there. But increasingly what we're seeing now, as more and more businesses move to make those large payments, is the need for greater security, greater transparency, greater controls, so that the authority to make those transactions is effectively controlled and delegated within an organization.
Yes, security is absolutely paramount, and that's something that was surfaced in the survey, and we're going to come back to that in a moment. I think it's interesting that there's, even with all of the innovation that we are seeing in commercial payments, there is still a lot of these kind of common or garden variety problems still exist that you mentioned, such as expenses not lining up. So we've got a few stats from the survey. So the survey, we really did go very granular on this. It captured a whole range of different, problems, challenges, opportunities that businesses face in their everyday life when dealing with their commercial payment strategy. 38% of businesses in the APAC region said that travel expenses not aligning with in-trip costs was a problem for them. And I think timely reimbursement for employees, also an issue, 38%. And then the ability to track, manage and forecast employee travel was cited by 34%. So there's still obviously work to be done there, and areas where businesses still need some support from their payments partner.
And I think that brings us on to our role as a payments partner here. So I'm today representing Discover Global Network. And I think our role here is a very interesting one. And I think the first thing I'd say, though, and we'll talk a little bit about, if I may, just talk a little bit about India, seeing as it's such a huge market, obviously. I think, first of all, India is blessed with many, many things. From a payments environment, it's blessed with a very active regulator. Now, a lot of people would see that as a challenge. I think it is a challenge, but it's also a huge opportunity. As a network, we view the RBI and the level of activity that the RBI undertakes, especially in the way it guides the payments environment, the payments industry, is an extremely positive one. I think the success of India and the payments within India is evidence of just how strong that influence can be and how effective that influence can be if used in the right way. I think the second thing I would highlight is what we're here today at this Fintech Fest. India is blessed with so many entrepreneurs, innovators, developers, new true Fintech entities. So I think there's a lot of excitement in the marketplace, a lot of interest in the marketplace, in bringing about efficiencies, savings, greater security. So I think you've got an active regulator, you've got a wealth of talent and opportunity within the fintech space, but then you've also got some very, very effective banks as well. Huge scale and very aggressive and very innovative as well. So I think those three things together, make for a huge potential, and I think just really, continued success for the Indian payments industry. But coming back to our role as a scheme here is our approach within India is to work with two major partners. So we differ from other schemes in that regard. We focus on a very small number of partners, but we focus all our attention and all our effort onto those partners. And in this market, our partners are NPCI through the RuPay network, and also HDFC Bank as well. So part of our role within India, working with those two partners, and especially when we talk about working with HDFC, our role here is to try and combine the strengths of the RBI, the talent that is within the fintech industry, but also the strength and innovation within HDFC as our partner there. I think it's one of the interesting things I saw in some recent survey was that people trust banks more than they trust fintechs. That is the reality. That is what the market is telling us. And I think that's understandable. I mean, almost universally, I think there may be one or two blips at times with various financial crises, but generally speaking, trust in banks is implicit. And I think what we can do as a scheme there is then to try and leverage the strengths of the fintechs with that strength and trust in the banks, to combine those two together to come up with not only innovative solutions, but also trusted solutions as well to help grow this payments industry.
That's very interesting that you mentioned the point about implicit trust in banks being higher than fintechs, and I think it's something we've actually seen in I think all regions of the world in our survey. As much as consumers love fintech, when it comes to deposit accounts, that's what they trust the most, and I think it's pretty much the same across the board for corporates as well. And I think it's fascinating with India because you've got this wonderful combination of a very supportive regulator and this huge opportunity that you've described thanks to formation of new fintechs and this great culture of innovation and entrepreneurialism. Are there any sort of specific opportunities in commercial payments that are kind of there for the taking in the Indian market as you see it?
I think in the Indian market, I think the challenge we're seeing, we always see is, and I would say kind of everything changes and nothing changes. So a lot of the challenges we're seeing about risk and controls and transparency, as I mentioned a few minutes ago, are still very much there in the industry. I think we're seeing that business travel, as I mentioned before, is back to pre-pandemic level, both in corporates and in leisure spend. But the areas of fraud, the areas of risk, the combining and collection of the data management, when we talk about travel business and we talk about level 3 data and how we can secure that and how that can be passed through, the payment and the reimbursement of taxes, sales taxes and those sorts of things, they're all prevalent still within the travel industry. And I think a lot of those things also move into the new environments that we're starting to see those payments, as I mentioned earlier, in terms of the need for control and accountability. So I think in terms of opportunity, then we're seeing the drivers are still largely the same. It's reducing fraud, it's controlling risk, it's bringing in efficiencies, making payments more cost-effective, more efficient, more secure. So those things are still very much in play. And I think it's our challenge as a scheme, all of your challenge as fintechs, and the banks as a challenge to come up with the solutions that are going to address those core needs.
So I'm going to come back to the fraud piece in a moment because we've got a few things to say about that. But I just wanted to kind of broaden the conversation out here to the wider APAC region. Are there any sort of particular opportunities in commercial payments or any particular markets that Discover Financial Services is particularly excited by at the moment?
I think from our perspective, we've talked a little bit about India. My responsibility is APAC region-wide. So really to talk a little bit about some other markets. Japan is developing very, very quickly. It's very sophisticated in terms of its travel business. It's looking more and more at regulatory payments. I think we're seeing the same in markets such as South Korea, Taiwan, and we're seeing a lot of innovation in Singapore as well. Clearly a much smaller market. But even though it's much smaller, we're still seeing a lot of innovation, a lot of fintech activity. And so, that's driving a lot of the innovation we're seeing because of its role as a regional hub. So I think a lot of the fintechs are attracted to the fact that there's a lot of companies that will have their head offices or regional head offices based in Singapore. So I think we're seeing a lot of activity in those markets as well.
Yeah, Singapore's certainly quite something of a fintech powerhouse. I do want to just move on to address the issue of fraud in payments. It's kind of an unavoidable issue, and it's been such an exciting time for the payments industry across the world. But unfortunately, I suppose it's also been quite an exciting time for fraudsters, because one of the quite sobering findings of the survey this year was just how huge of a concern fraud was for corporates and SMEs. Whether that was kind of, I would say, old-fashioned and traditional types of fraud like wire fraud and scams, right through to newer typologies of fraud such as bot attacks or AI-powered varieties of fraud such as synthetic identity fraud. But it was really, I think, one thing that came across loud and clear in our research was that security features, like strong security features, are something that sort of large enterprises and SMEs are looking for in their commercial payment strategy. So that was stated by 91% of respondents in the APAC region as a priority. And then fraud prevention, unsurprisingly, was cited by 90% of our survey respondents in the corporate and SME space. I don't want to leave this on a note of doom and gloom, because I think the other positive thing that came from the survey was that there is a huge level of motivation among corporates and SMEs, one, to kind of acknowledge the problem, to address it, but also to look for solutions, to look to partnerships, to sort of strike up good relationships with their payment services providers or card networks to kind of protect themselves and to make sure that payments remain fair and secure for everyone. So I was wondering, Chris, if you can tell me a little bit about how Discover, or how the payments industry more generally is rising to the challenge of fighting back against the fraudsters.
Well, that's a constant challenge for all of us, I think. I think I've always, somebody once told me to think of fraud as a semi-inflated balloon, in that you squeeze on one side and it kind of just pops out somewhere else. And I think that's a real truism. I think fraud is a constant challenge for all of us. I think, as I mentioned a couple of times, some of the challenges that we've seen over the years remain now within both commercial payments, but also as we're seeing more innovation in terms of new payments as well. And a couple of examples, so risk of misuse. I mean, that's a constant, whether that is a travel card, whether that you've issued somebody a prepaid card for their per diem, or whether it's a purchasing card and somebody misuses it to buy, a couple of bottles of champagne, perhaps, to celebrate something when they shouldn't have done. Data inaccuracies leading to inefficiencies. If you haven't got the right data, you're not collating it correctly, you can't claim the necessary taxes back. People can't make their claims effectively. They're claiming too much, they're claiming too little, all of those sorts of things. Inconsistent reporting. Again, that's another area that we have to address to make sure that there is that consistency. And so there are the necessary controls in place. Also, the cost of management as well. The oversight that needs to be provided. You don't want an army of people having to be checking that everything is working correctly. I mean, you're trying to build efficiencies and actually remove inefficiencies you really don't want to create another inefficiency somewhere else within the organization. So I think that's kind of the role that we have, is looking at the marketplace and saying, okay, so what are the opportunities? Who are addressing, what fintechs, what companies are addressing those challenges? And how can we work with our bank partner or partners in other markets to actually bring those solutions to life as well? And I think one of the most popular things that we're seeing at the moment, where we're seeing enormous interest, is in VCN, or virtual card numbers. And that seemed to be an opportunity across multiple different types of businesses or business opportunity. Whether that is in the purchasing card opportunity, whether that is in the travel account, so when you're looking at online travel agents, increasingly we're seeing corporates, although spend is back to pre-pandemic levels, we've seen the trend in spend is slightly different, in that it is more likely to be kind of economy class travel for longer journeys, more budget hotels, those sorts of things. So a lot of controls in there. And often what we're finding is companies are going direct. They'll have their own little travel desk or somebody within their organization responsible for travel. So rather than just relying on a third-party travel agent, they will actually use somebody in-house, and those people will then access online travel agents to actually secure the bookings. And that creates additional business and opportunity for those online travel agents. Where we see as an opportunity is the way in which those online travel agents then settle those payments with the respective hotels and airlines to fund those tickets. So the consumer pays the online travel agent. The online travel agent then generates a payment that is then made to the airline to settle that account and actually purchase that airline ticket or hotel booking. So opportunities such as that, I think, probably VCN is, if I had to pick on one product at the moment,
Yep.
in terms of growth, in terms of focus for us and interest that we're seeing from our partners, it would be that.
Yeah, I have to say also, like, the survey itself showed some really interesting findings around VCN. I mean, it seems to be like a very nifty piece of technology for a lot of corporates and SMEs, and those who have adopted VCN are seeing very clear gains in terms of business efficiencies, but also in terms of security. So 65% of our survey respondents in the APAC region said that using VCN had given gains in terms of security. And that number actually rose to 75% in India. And it seems like Indian corporates and SMEs are actually more keen on VCNs than their counterparts in other markets. But it's interesting that I feel like adoption of VCNs and actually levels of interest in VCNs is maybe not what it could be, given the obvious gains that are there for kind of corporate payments. So we actually saw that 54% of Indian corporates were interested in learning about VCN use, compared to a global average, that's all regions, of just 33%. So it feels like there's an opportunity that's maybe not quite being captured yet. Why do you think that is? And do you think there's maybe an education piece that needs to take place there?
I think there is. I think I would absolutely take the point that there's a lot of interest in it. At the moment, that interest hasn't yet translated into business, into adoption. So I think there is a huge opportunity there in terms of education, awareness as to how simple a VCN implementation can actually be. And I think that's partly on us. We haven't, as schemes, we probably haven't done a good enough job of communicating just how straightforward that process is and what those business benefits are. So I think you can rest assured that certainly we within Discover Global Network, are actively progressing a lot of opportunities across a number of those markets that I mentioned, as well as within India as well. Because we are seeing a lot of new adoption opportunities in different industries. Yes, we've talked about the travel industry, but when we also look at the statutory payments and tax payments and things like that, so large corporates, whereas previously they might have used a purchasing card type solution, which might well have been a physical card sitting in somebody's desk somewhere. You'd have to find the right person. They'd be the only person supposedly authorized to use it, but it would probably get handed around the office for different people to buy different supplies. All of that goes away with a VCN solution. It can be very tightly controlled as to the card number being generated, which is a genuine card number, but you can put all sorts of controls in place around that. You can limit the type of spend that happens to that virtual card number. You can limit the amount of times it can be used. You can limit the amount of money that is actually spent on that card. And you've got a full audit trail of who's generated the number and what transaction has been made on the back of it. So there are a lot of things that VCN addresses in terms of the ongoing and perennial concerns around corporate cards and travel cards in particular. So I think there's a lot of opportunity there for that. I do take the point that there is more for us to do. It's relatively early in the cycle for it, but I really think there's huge opportunity there.
I think what I quite like about VCNs is they're genuinely useful in the real world, but also not overhyped, like certain things do seem to be in fintech. But we've got a few more minutes left. I just wanted to ask you, are there any other particular emerging technologies in payments that you're particularly excited about from a commercial payment standpoint?
I think probably VCN I would put as number one. And I think that the opportunity for us is really about the use cases for that. And I think that's where we're starting to see the new opportunities. And I've mentioned several already this morning. I think that's the most exciting one for me. We're continuing to see the growth of travel cards. I suppose the other exciting one is, and I was actually at a celebratory event yesterday with our partner HDFC, is the space of SMEs. And I think that's probably the sector that is growing very, very, very quickly. It's always been an untapped market, or for a long time, it's been an untapped market. And that SME, it could be making small payments, it could be rental payments, it could be tax payments, it could be utilities payments, it could be as simply going to the wholesaler and buying his week's supplies that he's going to sell in his shop. So it could be any of those things, and I think what we're now starting to see is a lot of the knowledge and experience of the card issuers being deployed within the SME space. We've seen a lot of innovation on the consumer side, whether that's co-branded cards, whether that's loyalty points, whether that's cashback, whatever it is. And I think the exciting thing is that we're now starting to see that innovation in the SME sector as well, which I don't really think we've seen before. And there are some very exciting things going on there. We're seeing a lot of growth there. I mentioned HDFC as our partner. They're being hugely innovative and very, very successful in how they're tapping into that market. And I think that's proving very, very successful for them and for us as a network.
Well, I think that's going to be really exciting to see how that unfolds. I mean, yeah, surely India's got to be one of the most dynamic SME markets in the world, so no shortage of opportunity for the commercial payments piece here. So we're coming to the end of time. Chris, thank you. This has been a fascinating conversation. We've covered a lot of ground, ranging from the importance of regulatory support, the risks of fraud, the huge wave of innovation that we're in the middle of in commercial payments, which seems to be replicating some of that incredible and dynamic innovation that we've seen in commercial payments across the APAC region and especially here in India. Now, unfortunately, we do not have a QR code behind us for our study, but what I will say now is if you drop me a line on LinkedIn and briefly introduce yourself, I can send you a link. You'll be able to see some of the key findings of the study as it relates to commercial payments in India. And stay tuned for some of our findings on fraud for research that we've carried out in partnership with Discover Financial Services. So all that remains to say is thank you so much for joining us. It's been a real pleasure, and thank you, Chris.
Thank you, Sophia,
Thank you.
and thank you very much, everybody.
Thank you so much to both our dignitaries for joining us. May we request you to please come towards the center and allow us to give us a moment of getting you photographed together, the both of you. Once again, a warmer round of applause, and let's appreciate all the knowledge they have endowed at the Global Fintech Fest. And this concludes our fireside chat, and thank you so much, Sophia, and thank you, Chris, for joining us today. And ladies and gentlemen, let me take this opportunity to thank our gracious sponsors, Global Payments Partner, Discover, Banking Partner, Standard Chartered, Platinum Partner, Pismo, Gold Partners, Accel, O3 Capital, Silver Partners, JP Morgan, and Zoho, core banking partner being iDigiCloud. Also, don't forget to download the Global Fintech 2024 app. This app is your go-to resource for event schedules, speaker details, and real-time updates throughout the fest. So anytime you need some guidance, you know where to go to, which is the Global Fintech 2024 app. So ladies and gentlemen, with that being said, it is now time for us to move ahead towards our next session, which is going to be a trialogue on is this era of profitable fintechs. This session will be moderated by Ms. Upasana Thakur, who's the co-founder and CFO of MobiKwik. And the speakers being Mr. Sailesh Rajbhan, Chief Investment Officer of Equity Nippon India Mutual Fund, and Mr. Saurabh Mishra, Executive Director, Morgan Stanley Investment Management. Let's proudly welcome all our dignitaries towards the stage with a warmer round of applause, ladies and gentlemen. With that, Upasana, over to you.
Thank you very much. It's amazing to have my co-panelists, Mr. Sailesh Ban and Mr. Saurabh Mishra here this morning. I know that this is a still early morning given all the traffic issues that people are facing outside. So it looks like a thin crowd, but hopefully it will play up. I can tell you though that this discussion about profitable fintechs or fintechs looking towards capital markets is of immense interest to many late-stage fintech companies. So thank you so much for being here. My co-panelists today are just a brief introduction. Mr. Sailesh Ban, who is the Chief Investment Officer for Nippon Mutual Fund. I believe he's been associated with Nippon now for 25-30 years or more. And I have with me Mr. Saurabh Mishra from Morgan Stanley Investment Management. I think he has been part of the Indian tech space now for many years, both in operating roles as well as investing roles. So I think my interest was to have one global investor and one domestic investor so that we can get a feel on how both of them think about the fintech space. So with that, let's get started. I think first question just to warm up is, we all know that fintech is a very large opportunity in India, but globally, fintech as a sector has been taking a beating recently, both in terms of dollars invested as well as in terms of the valuations. So given the large TAM of India, how do you guys think about the fintech industry, specific, to the India growth story? And what are sort of the macro thoughts? What is the future for fintech from an investor lens?
So good morning, and thank you for the privilege of being here, making it. Let me just give a sense on the size of the opportunity you talked about, right? Clearly, if you count in numbers, it is very, very large, right? Second is the digital acceptability in India is way higher than most countries in the world, so that is there. And India also has a runway in terms of growth in per capita income in the next 20 years. So there is a lot more in terms of the universe which will come into the services which you would provide as a fintech company. The critical problem here is, like you said, the TAM size is large. The critical question here is, what is the TAM, right? And how do you address it while sticking to the regulatory environment and the regulations which are in play? And the minute you are able to get that right as any fintech business, right, you would find that the model works. The only problem which I see today is the TAM will take time to emerge. So currently it's payments, it's moved to maybe other financial services to some extent, but I think where will these businesses make money critically? So what is the profit pool rather than TAM should actually become the most interesting area to play with. And I think profit pools will emerge here. And I think it's a matter of time because today virtually most fintechs are giving a lot of services free, right? So I think slowly some pricing will come, some model will come where you're able to make profits out of it. And that profit pool is what will excite markets. So global markets or even local markets are excited by the size of the opportunity, but today the visibility of the profit pool is not very, very clear.
Great. So questions had two parts. One was global fintech, and secondly, how to look at India. So global, in my view, is just a reflection of where cost of capital is and growth, and somehow both are interlinked. So it's a cycle. At some point of time, the way we were up, we are down. I think we'll be out of that also. In Indian context, fintechs have a material role. The very first premise is that it's a growth enabler. We are an underbanked, underpenetrated society. And the biggest benefit, we call it fintech, but if you look at century of history, right? Every tech enables to reach to your customer at a lesser cost in a more efficient way. And it's the benefit that you put on the table and the cost-benefit analysis, right? That's what eventually will drive TAM, in my view. So in my personal view, there is a very long runway for the very simple reason where we are, the very simple reason the kind of risk-taking we have in the industry right now, the entire financial industry. If you compare with developed versus here, a lot needs to happen, and that's why I think there's a very long runway for that.
So thanks for that. Then I think the next piece I would like to move to is now, like you mentioned, payments. There are several payments companies that have come to scale. There's consumer payments, there's B2B, but then there's also wealth tech, there's also insure tech, and definitely digital lending. And these are some of the themes that seem to have exploded in the last 5 to 10 years. So amongst all of these areas, in the short and medium term, which are these themes or sub-sectors that the investor world is currently tracking and will be interested in?
We simply track profits. So we are seeing profits in wealth tech, maybe broking services, profits in lending. So see, unlike the VC world, which tracks creation of businesses, we have to see that all these businesses end up with a model where there's money being made. So a large amount of money pool or profit pool could be in lending, could be insurtech. Some people have executed well in terms of the consumer, acquiring the customers and being able to sell them. So these spaces are good. Other financial services also matter, in the sense like we have seen people create models around broking is extremely profitable, purely fintech-wise. So I think where the money is moving is these three areas, and we are chasing that. Payments, our hope is someday it will become extremely profitable. Someday where, there is either a pricing there or there is some regulatory support to getting pricing right, because that is a large piece where all the cost is today being incurred, right? I mean, and that I think will make businesses in the fintech side very valuable.
Again, if I take from 101, financial industry has these three elements. One is your liability mobilization, which is your raw material. You deploy into asset creation on which you earn. And third, you provide allied services, products on top of this, this railroad. Now the first two, which is liability and asset creation, both have risk-taking element and both have regulatory element. And in any fair evaluation, those will be the last where one can reach or probably take the full benefit. And that's why evolution always starts from either easing distribution or payment or allied services, allied product. That's where most of the fintech is. This doesn't take away the fact that at some point of time, the other two will also open up. And there are multiple companies, multiple models which are working there. Either, I mean, at the time you were doing co-lending or you were doing source origination, DSA, those kind of work, several companies. And that's where the biggest profit pool is. So eventually that will be a natural progression. All three will be addressed. That's we have seen across cycle over time that all three is going to come. So excitement is basically steps. The very first step is allied services products, which we are excelling at. Second will come asset creation, and third, which is the most sacrosanct from any regulator perspective, is liability. So excited for all three. I think it's a natural progression. It will happen. We are at the first stage, and I think across several companies, we have mastered that. I mean, we are seeing so many examples, without naming names, where we really drastically reduced the cost of distribution, really innovated the product, our ability to reach to the end customer, simple finger tap. So yeah, I mean, that's the thought.
So that's interesting. Saurabh says that, which I definitely agree with. We are just getting started. I think that there are many more layers to the growth story of fintech, as we will see. So one cheeky question I want to ask, just to bring a little fun. So I think we all know that in the Indian public markets, financials is a huge sector, right? Banks, NBFCs. So a question is that for fintech startups, that is going to be the cohort that is going to be thinking about the dialogue today. How do you treat them? Do you treat them under BFSI or do you look at them under tech or TMT?
I think truly these are a combination of both, right? So normal BFSI, especially the banking side, takes certain element of risk. So they have a very different, so they are valued at price to book and valued very differently. Fintechs, unless they have a very large piece coming from lending, which is still not so in most cases, it's more in services and all that, will be seen more as a services business, an enabler business. And as lending becomes a larger part, it will start getting valued on that particular element. So primarily it's about, if you're services, you have to deliver very good return on equity. I mean, if that is there in the system, I think markets will look at it wholeheartedly.
So I'll give a cheeky answer. We look everything sector agnostic. So we simply look at your merit, independent of sector.
I think the mic can be a little high.
So I'll just repeat, I'm saying we are sector agnostic. So we really don't look at it from any sector lens.
Okay. Actually, that dovetails nicely into my next question that I wanted to ask. So, we are fintechs. We know that we are operating in a well-regulated market like India. And so, let's talk about the elephant in the room. Regulation is definitely a key and important piece of how we build out our business models. So, essential question I wanted to ask is how are the investors and how are you guys thinking about this, that from growth and evolution perspective, do we believe that licenses will be sort of the bedrock? Like, for example, you spoke about lending and scaling lending. Or is there room for a pure play tech and distribution, companies and models to be around? Because I think that is also a very pertinent question that most fintech founders keep thinking about at different stages. That we know we want to build it like that, we think we want to build it like this, but from a long-term scalability perspective, how do investors look at it?
I think that's the challenge which, everybody is trying to face. The minute you go to licensing and, the whole owning the book and taking the credit risks, the business becomes of banking. It's not just fintech or fintech services, right? That is one element which is important. And if you don't do it and do it the way only services, you end up sometimes struggling because after a point of time, growth can become a challenge. So there are two different skills, two different elements. In both the cases, there is a regulatory element involved. I mean, if you've seen the regulatory challenges which some businesses have faced, I think, and even we are seeing a lot of regulatory challenges faced on the banking side, the traditional banking businesses. And most of those challenges coming on the tech side of banking, not necessarily on the credit side of banking. So if you have to play long, play big, I think the licensing opportunity is there where you take and understand and build an element of capability on those sides and then do it. And that will give you a much larger piece of a lending thing because at some point of time, who owns the credit risk will come into play when you are into a large lending opportunity. And everywhere there is a challenge that sustainability of growth will be questioned. But you have a lending license there. You have an opportunity to actually take that risk wholeheartedly, build an organization around that, and own that a bit. Yes, it takes capital. It's a long haul. It is there. But I think it will lead to possibly expanding your TAM.
So before Saurabh you come in, actually the question I'm trying to ask is I think most fintechs would want to have as much licenses as required to build, but not get into becoming an AMC. For example, let's just take wealth as an example, right? It's possible to build a distribution play without becoming an AMC. So I think, but the question I am asking is that do investors think of it like that? That this can scale. ये लोग बहुत आगे तक जा सकते हैं without becoming the manufacturing entity. That is the question I wanted to ask.
So purely manufacturing side, right? I mean, it's different capabilities than pure services which you're doing. So I think you need a completely different outlook to execute that. Even in the normal world, the regular non-digital world, very few successes of people building, the main manufacturing businesses while they have done broking or distribution very, very well. So it's purely a capability building and capital requirement model which is there, but purely without risk if you want to do distribution, because that is where I think there is better return on capital employed. And manufacturing is a 10-year journey. I mean, it will take, if you're successful, it will take 5 years, 10 years, because it's extremely competitive already. And every single product anybody wants is visible today. So only in lending, because there is an element of capital involved and there's a significant element of credit risk involved in it, right? How the regulator sees that and how much ownership of the risk lends at the person who's originating and person who's putting capital. I think that is an issue which is most fintechs are facing challenge with.
So what you asked is a very fundamental question. Let me try to address it from 2-3 point of view. The very first, which is the conundrum of do you want to be a manufacturer or distributor? It simply depends on the industry. We have industries, let's say FMCG, where the core of the business is brand and distribution. You can get it manufactured in a supervised facility on a third-party balance sheet also, right? So if you want to be a manufacturer or distributor, depending on the industry, actually lies where the core lies, right? Now, I include the licensing part. At 30,000 feet view, why there are licenses? Licenses are nothing but to instill confidence in consumer that the product is safe, or if you are drawing liability for them, that deposit taking institution is safe. So licensing is nothing but an expression from a regulator, from a trusted body saying that these are the safe activity for a person who doesn't have time or required effort needed to go through if a balance sheet is right or whatnot. So licensing was a natural progression. Now, we loosely call fintech everything. As I said, fintech can be distribution, can be asset, can be liability, and depending where you are operating will require if you need to take license. If license is the core of the activity. If distribution is core, then yeah, I mean, you might be okay simply doing distribution. But at the end of the day, any company, I mean, the very fundamental principle I follow, if you are in a company, be what is core to the company. That is true for any company operating in a sector also. Be what is core. So licensing should not be seen something that this is licensing and can we do outside. Licensing only is required once that is core. So depending where you are operating.
Got it. So in a nutshell, even without having to go for the heavy duty licenses, there definitely seems to be a room to play, especially from a distribution perspective. I think that brings me sort of to the next and very hot topic which every founder wants to ask every investor, which is that there is a lot of opportunity. We know that today about 850 million Indians are banked, but even so, financial services has at the max reached some 100 million or 150 million Indians, at least one financial service. So there is definitely a very large market to go after. But then, as companies that are building out any of these financial products, how should one think about the growth versus profitability conundrum, right? Because on one hand, if you're doing well and your business model is showing potential, you have the opportunity to grow faster and capture a very large market. And right now we are still in the early stages of the fintech industry in India. Even as it is large, it is still very early. So versus thinking about there's this intense pressure to be profitable or to be on the path to profitability. So I think this is a very important and pertinent debate. And I think it also, dovetails into the fact that, do you guys have a secret formula? Like A plus B is equal to C, where there's some weightage to growth and there is some weightage to profitability. Because agar aisa formula hai, then I'm sure, all the fintech companies want to know about it.
See, there's a big difference in venture capital, private equity money than public market money. Public market money has a different set of return expectations and a different set of risk profile, right? The problem which I see in a lot of fintechs and a lot of new age businesses is, because private equity money has dried out or there is an exit requirement there, they're coming to the market very early, right? So either you have to compromise on the model or you have to become self-sustaining, because you can't have multiple raisings of capital in public markets very easily unless there is a demonstrated growth, and it takes 3, 4, 5 years to build that confidence. Second is your question on profits versus growth. Growth, anybody can get it in the world. If it doesn't have to come at the whole thing is at what right cost, And we have seen, not just fintech, but, other new age businesses have seen phenomenal growth and they've executed well. But when it comes to the minute they start looking at profits, the growth rates drop. So the basic question for investors is whether you're buying growth at this point of time or whether that is the real growth in the system. See, many businesses fail because they ramp up growth way ahead of time. And that growth comes at so much cost that you don't have the way to run. I think any business is a marathon. No business is going away. Growth in India is never going away. So please chase right growth rather than chasing growth at any cost. So when markets are good, like, in today's markets, people will respect growth over profits. But see, you are building a business for the next 10, 20, 30 years, right? So there'll be phases where people in the equity markets will respect growth over valuations, right? Or growth over profits. But I think if market swings somewhere and you have a challenge in terms of way people start looking at it, which has happened so many times, you will actually end up having to compromise on the model after being listed, because markets may again shift to say, boss, you have to show profitability. Most businesses which have listed in the last few years, you would have seen that all of them have got fantastic valuations when they started demonstrating their ability to gain profits. And we would want to buy not just on profits, but a right to win for those businesses. The minute we see that the right to win only comes because of capital and not capability, there is a big challenge for public market investors to evaluate them, because those businesses get derated very, very sharply. So the construct would be, yes, growth is needed. So it cannot be a very low growth business given the opportunity which is there. But if you're growing at 100% at the cost of profitability or at a significant cost of profitability, we are unable to decipher whether you're buying growth or whether that's the real growth in the market. And if you can solve that confidence factor to public market investors, I think people will like the businesses.
So I mostly agree with what Shailesh has said. We'll just put a couple of thoughts on that. We look from a lens of growth profitability, but at the core, if you ask anyone, any valuation framework, profitability is sacrosanct. You give value because you believe in future profits will come. So the debate is not growth versus profitability, it's basically when profitability will come, right? You want to tap growth ahead in future and probably become profitable at a certain point of time. Now, two types of conflicts arise in this. One is what kind of capital you have access to, and capital in the terms of duration, right? And you mentioned I've worked on both corporate private side and this side also, and the appetite and duration of capital is different from both, right? So if someone has longer appetite, longer duration, probably gets aligned with certain profitability model. Now, for whatever reason, if you are tapping a public market capital, another conflict that comes is, which is, if you are private, right, you have few investors, you can probably share more information, you can probably more aligned, probably vision aligned. Once you become public, you disclose for a number of reasons. One, let's say, competitiveness, right? You can only say this much. So outsider can only look to certain extent. The horizon is limited, and that's where the reaffirmation that profitability will be there is important. And that's where the second conflicts come, that the duration available to you and the strategy that you are running, are they in sync or not? And that's why we see all the moves, is because information asymmetry. So in my view, I mean, profitability is nothing but given. You have to be, right? It's duration that needs to adjust, which makes for your growth of profitability.
No, so just to ask a follow-up question on that. So I think profitability is a given, is what Saurabh said. So of course we all know that eventually everybody wants to have a profitable business, but the build-up to that is also there, right? So I think I'll just, re-ask this question a manner that, of course, people are looking at, we can become profitable next year, we can be profitable in 2 years, we can be profitable in 3 years. And on the other hand is, what percentage of growth can we achieve? If I want to be profitable next year, then my growth rate this year cannot be maybe 80-90%, maybe it will be 30 to 50%. So that is actually the question I'm trying to ask. Given the times that we are in, where we know that the private markets are not being very kind to this sector, at least in the last 1.5 years, and the public markets are showing opportunity. So if there are fintechs who are looking at the markets, let's say in the next 2 years, how should they think about this? Any percentage of growth is okay so long as you're profitable, or at least a decent double-digit growth rate, but with the way to show profitability in the next 2 years itself.
See, there is, showing profitability will not matter, because everybody knows that they are sustaining profitability. So I think it's a very interesting question. And see, what we look at as investors is, what is the sustainable profit structure? First, you said to be profitable. First is, to be profitable is not the only thing. You have to have some return on equity in the business, because everybody has to earn an X amount of IRR. So one is that threshold of profitability, right? And if you look at 3 years out, 4 years out in the business, are there unit economics in play already to reflect and demonstrate that, is the question, right? If that is visible, people are willing to give as long as a rope possible. Globally, they've given to so many businesses, even in India you will have. Second is, it's not that 70-80% growth markets will like that, or markets will like lower growth but higher profitability. I think markets will like a combination of growth and profitability. One at the other's cost. See, because we also don't know 5 years out whether the competitive intensity is so much that a lot of business will never turn profitable. See, in private markets, the failure rates are very, very high, right? And a few companies have managed this transition to public markets, and a lot of them are sustaining because they've raised capital from public markets. Otherwise, they've had their own challenges as well. So to move this transition, I think what is the right amount of growth is the right amount of growth which comes with the unit economics which are there. So it may not show up in reported profit numbers today, but unit economics should be good. They should not keep on deteriorating for you. As outsiders, like you rightly said, we don't know data as to when the unit economics are starting to deteriorate for companies when they are focusing so much on, I would say, very large growth. So maybe qualitative factors like, what type of customers are coming to you, right? So every customer is not the same customer. Today, everybody has 10 crore customers, right? So if you combine, we will have more than the population of the world as a customer base for our fintechs, right? So the idea is not to get that matrix right. Are you getting the critical 1 crore customers in India first to make your money? Then are you building the next 7, 8, 9 crore for the next 10 years? So I think it's about getting the model right. It's not about what growth you chase. Growth at a cost will come to any business. If you give free, growth will be 100% every year or even more forever, right? I mean, so I think the key question is you have to marry both of them. You have to see that your business should exist without capital markets. And then the capital markets will respect you so much and give you valuations which you can't even dream of. And that's what is happening in so many businesses today. But the minute you're vulnerable to a model or vulnerable to capital for growth, no capital market will give you money at the right price. And if you don't get money at the right price, it's itself a capital, it's a competitive disadvantage.
So you covered most of the point. I mean, at the end of the day, I'll just pick one line that you said, which is one can become profitable next year, but cutting growth. I think public markets distinguish between one cutting fat versus cutting muscle. So cut should not be on the muscle, one is cognizant. Second, growth, yes, and as correctly said, unit economics is a reflection of that growth, which gives the visibility that the growth that you are chasing will yield return in my duration, in my time frame. So I think both are important. I mean,
so the next question in line with this is, how are you valuing these companies now? I think that is what all of us want to know.
See, valuation is a judgment factor, right? I mean, like you mentioned, if there is a right to win, the leeway to the time frame which we have in mind is way larger and way longer. If the business, we think in a 3-5 year period will get significantly commoditized, we'll be very careful about what premium and what valuations we'll pay. Second is there an ownership of the customer? See, in fintechs, what we are finding is, are they only become transacting tools where you're unable to charge as well? Or you have built businesses in certain areas of wealth tech or various other areas where you're able to own the customer and earn profits out of it. So we value that portion maybe 5 times sales and this portion maybe 1 time revenues or 2 times revenues. So I think it's clearly a difference on which segment of the business you have created your right to win. And I see fintechs doing everything. Everybody wants to be horizontal, right? I mean, doing everything, right? It's so tough. I think no horizontal has really become, maybe very few have become material and meaningful.
So, but there are so many banks also, right? Banks are also horizontals.
Yeah, there's a difference. Banks started in an era where customers didn't have choices. See, till the last 10 years back, prior to that, there was no choices. There were few banks. They were a large part of public sector banks. Till 15-20 years back, lending was not so much. The consumer credit had started. So it was a very early stage. See, there are stages. In that stage, even an average bank could have become very good. In this stage of fintech, the best fintech only can become very good. So it's not going to be that, and cross-selling, you know, a lot of these banks had a strategy. They owned the customer and then could do the customer life cycle because the customer virtually couldn't exit from them because there was no great competition at that point of time. Today, you're seeing banks are facing competition on deposits. So thanks to you all, you have made so easy and so transparent the tech is for people to move. So nobody can believe how much of CASA they have. It can switch in 15 minutes.
Thank you. Now I will try to wrap this up because I can see the ticker. So I'll start with you, Saurabh. Reverse 30-second investor advice from all the fintech founders here, and then I'll ask Sailesh you to give the same.
A couple of bits. One is life is always compromise, and you try to arrive what is the most optimal winning solution for you. Match your strategy with the duration that is available to you. Build a model which is more robust, and at the end of the day, I mean, don't think about much of valuation, everything. I mean, see, at the core, if you can generate return which is more than your cost of capital, and you can grow from your own returns, everything will follow. So eventually, it's just creating a right business model with the right duration from the capital available to you.
I think Saurabh has captured it well. So clearly, it is about capital market will give money to people who don't need it. It's like banks. If you're so good in your model, then people will love to own because you can grow for the next 15, 20 years. So unlike the perception, capital markets also look 10, 20 years. But, you know, they have to have the confidence that those businesses can grow. So getting your business model right in the context of where is your right to win and where you can have a return on equity. In no fintech presentation till now, I've seen return on equity as a slide. Right? It's only customer acquisition transactions. I think the world has changed. And I think the minute you reach that area where you can say, I'm self-funding my growth of at least 20-25%. For higher growth, I need capital. The world will give you.
Thank you so much. I think the last words are the important ones coming from, both our investors as panelists. Right to win and return on equity needs to be there in all the fintech presentations. Thank you so much.
Thank you.
And before our panelists part ways with us at GFF, we just like to give an opportunity because we've been seeing such an engaging audience. If the speakers are okay, can we give them a moment to ask maybe a question? Yeah? All right. Can we have the mic please pass to the gentleman here? Firstly, a very warm welcome, sir. A very good morning, or rather edging towards the afternoon shortly. While you're asking the question, maybe just request you to say your name as well and keep the question concise, and whom would you like to address it to?
So my name is Vikas Jalan. I'm CFO for one of the largest fintech distribution companies, Pay Nearby. And my question is to Mr. Sailesh. We've got very interesting insights from you, but on the profit pool, what kind of duration do you look at? Because there's no set formula where at least we've been able to figure out in all these experiments that we've been trying to do. So what is the duration of profit pool as an investor would you like to see? Thank you.
It's a very important question. Any investor gives you money, anybody is giving money or you're giving money to someone, he expects, because it's equity risk, he expects a 15% IRR, right? So if you're taking money in year 1, and in year 10 also that profit pool is not coming, or year 7 also it's not coming, then it's just not possible to create value on the initial 1 rupee invested. So the time frame is a function of what is the size of the pool in front of you and how long you can survive, because every time you dilute at a much lower than what the optimal value for your business is, the ability to create value declines, because the dilution leads to equity dilutions and lower returns to investors. So I think there is no formula to it, but the question is postponing the profit pool or postponing saying that we'll grow first and profits will come, will, I think, endanger or will create maybe the failure rates will be very, very high. Because we have seen any business, anything we predict, I can tell you that prediction is always wrong and always off by 3-4 years. And based on that experience, we built in a cushion in terms of what we pay for those businesses. So one is the profit pool has to be large for the public markets to be interested in, right? The second is that if it's taking 10 years to get there and the size of the pool is not enough, it's not worth fighting that battle. I mean, it's not worth winning that battle. Most fintechs have virtually there in every vertical. I mean, you open an app, it is exactly similar. It's a photocopy, right? It's just the experience is different somewhere, or it's actually the same thing, right? So you have to give the customer why one should choose that over something else. I think if you get that, then you get your profit pools and everything right. And time frame, bull markets give you a lot of time. Bear markets just don't give you time. So I think you have to work with a phase that in a 2 or 3 year period, you can even end up without capital. You still have to stay there. I think there will be a lot of shakeouts there. And those who stay longer with right capital and don't burn themselves early in the cycle will have a long runway to win.
Thank you, Mr. Ban. I believe there's one more question. We'll quickly get the mic passed to the gentleman in the blue. Sir, just your name and, of course, whom you'd like to address the question to.
Hello, my name is Anuj and I am from Fintech. I would like to ask, in this time now, Lion is awakening. Banks, mutual fund, AMCs, all are awakening with digital techs. So where should the fintechs look upon? Because like you said that there is a photocopy of models on multiple fintechs. So exactly where is the opportunity coming from when Lion is awakening?
Is it addressed to any particular speaker?
Yes, Suhas.
Okay, Saurabh?
So let me answer it in a way. See, every time, in every era, there will be a Lion, something will be doing something different, right? And while I don't fully subscribe to, but yeah, everything looking similar kind of tells you that there is a part of uniqueness, plus there is a part of commodity also in the business, right? And in that, one really needs to understand the operational excellence and culture. And you need not go further. I mean, we jokingly were talking, but if you simply look at BFSI space, look at companies which have been there for 20, 30 years, and simply look what makes someone operationally excellent, how they derive the synergies, the benefits, how the organization is cohesive, how they make people grow, those eventually become the differentiator in the long term. And there are n number of examples. Unfortunately, I cannot take a specific company name, but if you simply look around, do a 20, 30 year, who has been there and consistent, and very simple filter can be growing more than cost of equity, 14, 15% what Sailesh said. And answer will be in front of you, how you survive and thrive over long term. I mean, innumerous examples.
Sure. Thank you so much. One final question. Yes, to the gentleman in the black. Yes, let's get you to ask. You just request your name and whom you'd like the question to be addressed to.
Yeah, hi. My name is Ashish. Question to Saurabh. I run a venture studio, which is run with the aim of helping very early stage startups. Oftentimes, entrepreneurs come to me with interest in doing something in fintech, but they have very little idea of all the regulations, the next 10 years, how things will look like, and so on. Maybe could you talk about, for a person like me, when a very young entrepreneur comes, what are some of the 3 things I can tell the person about starting off their journey building a fintech company and how they should look at the first 3 years?
So I'll draw from my experience, from my earlier experience where I was on the private side. See, someone not knowing also is a benefit in a certain way that most of the innovation happens when there is a disruption, and disruption normally happens once you don't know the set ways of life in certain industries, certain walks. I mean, again, history is filled with examples. So not knowing is not an issue. What you need to judge is 2, 3 things. One is, has the problem statement been identified correctly? If there's a problem statement, then you basically look, does that person has right tools, means it can come from experience, network, team, to solve that problem. Once these 2 are there, then the next phase come. I mean, I'm basically relying on the very basic economic framework of land, labor, capital, and entrepreneur combines them and makes something bigger, right? So basically what you are looking is, you are the provider of capital, and land is nothing but resource and the person. Can someone combine right problem statement, can generate something out? If these 2 elements are there, normally things work out. But again, I mean, I don't want to over project. You are in very early stage. The success failure rates are very different than normally what we experience. So we'll not over project or over answer this question, but I found these 2 traits very helpful, at least in my earlier part of career when I used to be a bit on your side of the things.
Sure. Thank you. And with that, ladies and gentlemen, our panelists have been so gracious with the extension on the time as well. We really thought that this topic could use the audience because they've been so curious in the questions. So with that, let's give them a bigger round of applause, ladies and gentlemen.
Thank you.